Two people, same city, same age, same income, same $50,000 sitting in a savings account, earning almost nothing, waiting for a decision. Daniel puts his into a rental property. Ryan puts his into a total market index fund. Both of them are 32 years old. Both of them are reasonably smart about money. Neither of them is reckless. Fast forward 20 years, and both of them have built something real. The numbers are closer than you'd expect, but the story of how they got there, the weekends, the tax bills, the phone calls at 11 on a Tuesday night, the absolute silence, that story is completely different, and that difference is the whole point. Most versions of this debate are made by people who have already decided who wins. The real estate camp quotes gross cash flow and forgets to mention the roof. The index fund camp quotes historical returns and forgets to mention that most people panic sold in March 2020. Both sides are showing you the thumbnail. This is the complete version. Daniel uses his $50,000 as a down payment on a $250,000 single-family rental in a mid-sized city with a reasonable rent-to-price ratio. He secures a 30-year fixed mortgage at 6.5%. His monthly payment, principal and interest, comes to roughly $1,264. He rents the property for $1,750 a month. On paper, before anything else, he is cash flowing $486 per month. That number sounds good. Write it down because it is about to change. Ryan takes the same $50,000 and puts it into a total market index fund, something like VTI or VTSAX. He also sets up a monthly automatic investment of $300, roughly approximating what Daniel expects to net from his rental. He does not think about it again for the rest of the month. His coworkers do not ask him how his portfolio is doing. There is nothing to drive by. If you asked him what his investment strategy was at a dinner party, the conversation would end in about 8 seconds. That is, as it turns out, a feature. If you have ever watched a video like this one and felt like someone was building a case before the evidence was in, this channel is the antidote to that. Subscribe now. The honest version of this debate takes longer. It is worth it. Back to Daniel's $486. Property taxes on a $250,000 home run approximately 1 to 1.5% of value annually. Call it $3,000 per year or $250 per month. That number reduces his cash flow to $236. Landlord insurance, not homeowner's insurance, landlord insurance, which covers liability and lost rental income, runs meaningfully higher. Budget $120 per month. He is now at $116. Vacancy. Even a well-managed rental in a healthy market will sit empty for some portion of the year. 1 month per year is the standard conservative assumption. That is $1,750 annually, or roughly $146 per month when averaged out. He is now negative $30 before he has fixed a single thing. This is where most landlord math stops. It should not. Routine maintenance, the small repairs, the seasonal upkeep, the things that do not make headlines, runs approximately 1 to 2% of property value per year. On a $250,000 house, that is $2,500 to $5,000 annually. Use the midpoint, $31 per month. He is now negative $61. Capital expenditures are a different category and they deserve their own line. The roof on a single-family home costs somewhere between $8,000 and $15,000 to replace. It needs replacing every 15 to 25 years. The HVAC system costs $4,000 to $8,000. Water heaters, appliances, flooring, windows, these are not surprises. They are scheduled future costs that every property owner will eventually pay. A reasonable capital expenditure reserve is $100 per month. He is now negative $161 per month on a rental that was supposed to net him $486. If Daniel self-manages the property, he has converted $161 per month into unpaid labor. The average self-managed rental requires 5 to 10 hours of attention per month when things are running well, and significantly more when they are not. If he hires a property manager, which costs 8 to 10% of monthly rent, That is an additional $140 to $175 per month. He is now $280 to $336 per month negative on paper, and none of this accounts for the tenant who stops paying rent in month 14, skips the state by month 16, and leaves behind damage that costs $4,000 to repair after a 2-month eviction process. This is not a horror story. This is the math, and the math has to include everything before it means anything. Here is what that actually means for Daniel at year 5. His property has appreciated at roughly 3% annually, which is the long-run historical average for residential real estate. The house that cost $250,000 is now worth approximately $290,000. His loan balance has dropped to roughly $228,000. His equity position, the amount he actually owns, is approximately $62,000, up from his initial $50,000. That is a real gain. It looks modest. But here is where the real estate math changes. Daniel did not invest $250,000. He invested $50,000 and borrowed the rest. He controls a $250,000 asset using the bank's money at a fixed rate. When the property appreciates 3% on the full value, the equity growth is measured on $250,000, not on $50,000. That is the leverage advantage, and it is genuine. No brokerage account in the world will give a retail investor 5-to-1 leverage at a fixed 6.5% interest rate for 30 years. This is the part that real estate advocates are right about, and that index fund advocates consistently underweight. Ryan at year 5, his $50,000 has grown at the historical total market average of approximately 10% annually. That $50,000 is now roughly $80,500. His additional $300 per month, compounded over 5 years, adds approximately $22,000. Total portfolio value, roughly $102,000. He has not made a single phone call, attended a single showing, or spent a single Saturday getting roof estimates. He has also not captured any leverage. His gain is entirely his own capital working. The gap between them at year 5 is approximately $40,000 in Ryan's favor. But that number is misleading in both directions. Daniel's equity is partially captured in a non-liquid asset in a specific zip code. Ryan's is fully liquid, fully diversified, and immediately accessible. Those are not the same thing. At year 10, compounding starts to show its full character. Ryan's portfolio, original $50,000 plus 5 years of additional monthly contributions, is now worth approximately $230,000, assuming continued 10% annual returns and continued monthly contributions. That number is not guaranteed. It is the historical average. It has also been earned without a single management decision. Daniel's property is now worth approximately $335,000. His loan balance is approximately $207,000. His equity is $128,000. The leverage worked. The appreciation worked. The math of controlling a larger asset is visible in that equity figure. What is harder to see is the cumulative cost of a decade of ownership, the capital expenditures that did materialize, the vacancy periods, the months where cash flow was negative, the management time. Subtract a realistic estimate of those costs from his equity position, and the gap between the two investors shrinks but does not disappear. At year 20, the numbers land here. Ryan's portfolio, with consistent contributions and historical returns, is somewhere in the range of $800,000 to $1 million. The range reflects the honest reality that markets do not return exactly 10% every year, and the sequence of returns matters. Daniel's property is worth approximately $450,000. His mortgage is nearly paid down. His equity is roughly $250,000 to $280,000 net of remaining debt. If he has refinanced strategically, used a 1031 exchange, which basically lets you roll profits into a new property without paying capital gains tax right away, and scaled into a second property somewhere in the middle, his total real estate equity could be substantially higher. Under those conditions, the comparison changes dramatically. That is the conditional answer, and it is the only honest one. Ryan wins the 20-year comparison under one set of conditions. He held through every crash, the 2008 drawdown, the 2020 collapse, the corrections in between. The data on retail investor behavior during large market drawdowns is not encouraging. During the 2020 crash, a meaningful percentage of individual investors sold at or near the bottom. The strategy works if you hold. The historical 10% average is a number that belongs to the people who stayed. Most people do not stay. That behavioral failure has a real dollar cost that never appears in the compound interest calculation because the calculation assumes you behave perfectly. Most people do not behave perfectly. This is not a criticism. It is a description of how human psychology interacts with abstract numbers moving in the wrong direction. A 35% drawdown on a $400,000 portfolio is a $140,000 paper loss that feels like anything but paper. Daniel, watching his property during that same period, drove past it on the way to work. It was still there. It still had tenants. The roof was still the roof. That tangibility is not a financial advantage in the strict sense. It is a psychological one, and psychological advantages have financial consequences. The honest Steelman of index funds, zero management time, complete liquidity, instant diversification across thousands of companies, no concentration risk in a single zip code or a single tenant's credit score, no capital expenditure reserves required, and the ability to increase returns simply by adding more money each month without adding a single hour of complexity. These are genuine advantages that real estate advocates consistently underweight. The honest steelman of real estate, leverage that is unavailable anywhere else at retail terms, depreciation as a tax shelter that reduces taxable income on paper even when the asset is appreciating in reality, the ability to force appreciation through improvements, cash flow that exists independently of market sentiment, and the psychological anchoring effect that keeps some investors from making behavioral mistakes they would otherwise make in a volatile brokerage account. Neither of these is a complete answer on its own. They are inputs. Real estate wins under specific verifiable conditions. The rent-to-price ratio supports cash flow from day one. The investor manages it as a real business and not a side hobby. Tenant screening is rigorous. Capital expenditure reserves are funded monthly before the expenses arrive, and the tax advantages are actively used. Under these conditions, real estate builds wealth in ways that compound through leverage and tax treatment that stocks simply cannot replicate. Index funds win under different conditions. The investor wants simplicity without management, values the ability to liquidate without a 60-day escrow, and, most importantly, has the temperament to hold through a 35% drawdown without logging in to do something about it. Under these conditions, the compounding is real. The returns are market returns, and the time cost is approximately zero. The combination of both, deployed in the right proportions for a specific person's temperament and life structure, is where the math changes most favorably. That is a longer conversation. Drop a comment. Are you team real estate, team index funds, or are you doing both? Here's the only thing that actually matters about this debate. It is not which investment wins on average. It is whether your analysis includes everything: the gross cash flow without the net, the appreciation without the leverage cost, the historical return without the behavioral failure rate, the equity without the liquidity discount. Any analysis that leaves out the uncomfortable parts is not analysis. It is marketing dressed up as math. Did you include everything? That is the question that separates a real financial decision from a compelling thumbnail. Both Daniel and Ryan built something real over 20 years. One of them spent those years building a business they happened to own. The other spent those years building nothing, and that nothing compounded into something significant. Which one that sounds like is entirely up to what you actually want your next 20 years to look like. The honest answer is that both of them asked the right question. The question was never which investment wins. The question was, did I run the complete number or just the one that looked good?